Hey everyone, Eric here. Today, we're going to discuss how to calculate net present value and the internal rate of return and how to use these two metrics to analyze financial investments. So first, let's talk about net present value, or as we say, NPV. So would you lend me $1,000 today if I promise to pay you back $1,500 next year? Well, the answer should depend on how likely you think it is that I pay you back next year. This is exactly the type of situation that NPV helps us analyze. It is used to evaluate the risk-return profile of investments. So let's look at a few examples. In example one, we are talking about investing in a private equity style company. These are companies that typically are profitable and are growing 10, 20, 30% a year. Not super risky companies, and companies that also aren't growing at a tremendous growth rate. So, in this situation, we say that we are going to pay $3 million and then we will get this stream of dividends, and then in year 7, we're going to sell the company for about $5 million with one last dividend. So in order to calculate the net present value, you need the cash flows, so what you pay for the investment and what the investment pays you back. You also need a discount rate, which is called the working average cost of capital. They are synonyms. And with those two things, you can calculate the net present value. So, what is the net present value of these future cash flows? First, let's talk about the discount rate. So, the discount rate is going to change based on every potential investment. The discount rate tells us how risky the investment is, how likely we think it is that we actually get paid back. So, this is obviously going to depend on some basic economic things like inflation, opportunity costs, that could be, other available investments. And then it's really going to depend on the company and the industry. So the company, depending on how much debt or equity the company has, that's a big one. And then the biggest one is going to be the overall sort of risk of the business. Like certain industries are very risky. They're very likely to get regulated, or maybe the company has a unproven business model and is growing really fast. But for a company like this, we would consider it pretty low risk. And in this case, we could probably give it a discount rate of around 10%. Again, there's a formula to do this, but for this video, this is going to give us a reasonable result, and this is the type of discount rate they would use for a business like this. So let's talk about the NPV formula first. So year 2023, we're saying this is historical numbers, so this already happened. And 2024 to 2030, this is our forecast. These are the cash flows that we hope to get in the future. So the NPV formula is equals, you take the future cash flow in year 1, then you divide it by 1 plus the discount rate. So that will reduce the number. Let's hit F4, and you'll see that will anchor the cell, that will lock the cell so we can copy the formula forward. And then we're going to raise the denominator to the number of years in the future we are. So in this case, we're 1 year in the future. So we could do 1, but to make it more automated, I'm going to do 2024 minus 2023, and then lock 2023. This is so that we can just copy this whole formula forward and we don't have to rewrite it. So now let's hit enter, and you'll see that in year 1, we've estimated this future cash flow in today's dollars for the net present value to be $136,000. So if we copy this forward, you'll see that 7 years out, you have $5,354,000. And this year, we're planning to sell the company. So we're saying that the company is going to be worth about $5 million, and we're going to also receive one final dividend. But in today's dollars, in the value of today's dollars, it's only worth about 2.7 million because there's so much risk that far out. So the net present value of all of these future cash flows, we do equals sum, and we just add these up, we're saying is $3.7 million. That's what this investment is worth today for us. There's also an automated Excel formula which calculates the exact same thing and can make your life a lot easier. So this is NPV, open parentheses, and all we have to do is click our discount rate, comma, and then grab the future cash flows. This will do the exact same math. Check this out. Close parentheses, hit enter, and you'll see that you will get the exact same number. So if you want to do it manually or you want to use the formula, the choice is yours. So this whole thing works without a purchase price. So when we're looking at purchase prices, we obviously want the purchase price to be either this number or lower. So let's say that there is an offer, we have an offer to basically buy this company for $3 million. What is the return of that? What exactly is that? So this is where IRR comes in. So the formula is IRR, internal rate of return. And all we need to do is just grab, including the purchase price, which needs to be a negative number, obviously, because it's cash out, the purchase price, and then the series of future cash flows, comma, and you need to put a guess in. This can be really any number. It just needs to be some sort of positive number if you think it's going to be positive. So let's say 10%, and then Excel will basically figure it out. So equals. So in this case, we're seeing that the internal rate of return for this investment is actually 13.9%. So this is the return, and we've estimated the risk to be 10%. So in this case, we can see that the return is in excess of the risk. And this is proven by the fact that the net present value of future cash flows is higher than the actual price. So this looks like a good investment. One other note, the internal rate of return, this is actually the discount rate at which our net present value becomes exactly equal to the purchase price. Check this out. So if I just copy in values, you'll see our NPV becomes identical to the purchase price. Why? Because this is the rate at which the return and the risk are identical. So if I just go back, we like the return profile to be higher than the risk profile, and in this case, I would say, this is an investment that we should pursue. Let's look at the second example. This is a public tech company. Let's say it's a company growing really fast, maybe 50% a year, and a lot of revenue growth, but the industry itself has a lot of competition and is very, very likely to get regulated. So there's actually a lot more risks, whereas this company is in some sort of a safe industry. This industry is changing extremely fast. It's being regulated quickly. So the risk of this company is higher, but it's growing 50% a year, so the returns are way higher. So in this case, we're saying, okay, today, one share of this company in the open markets, let's say it's a public stock, sells for $300. We've done the projections and we think that the price is going to be $1,000 7 years from now. Should we invest in this? Well, you're probably thinking, yeah, of course, more than 3 times your money. Well, not so easy. First, we need to look at the discount rate. So, in this case, let's say that we've effectively done the analysis on the WACC, and it's much higher. It's about 17.5% because this company has a lot more risk. So, in this scenario, let's use our automated NPV formula, get 17.5%, and grab the future cash flows of this company. Okay, what does it look like? We're saying the net present value of those cash flows is $323. So while $1,000 might sound pretty good 7 years from now, in today's dollars, it's worth just a little more than the actual price. And so that's probably what the market is saying as well. It's discounting the risk of the company and saying, okay, this is only worth $300 because there's a lot of risk. What about the internal rate of return? IRR, look at the values, grab the whole thing. Let's say we think it's 20% or something. Excel will tell us. Okay, so it's 18.8%. So in this case, you can see that the potential return is in excess of what we've estimated the risk to be. So in this case, we think that this return actually does compensate us for the riskiness of the company. So in this case, again, 300 is probably a good price as long as we've done a good job evaluating the risk of the company. So in the third situation, let's talk about a pre-revenue startup. What does this mean? This means that there's, let's say, a really experienced team and they've developed a concept for a new product. And they haven't actually built the new product. They need $1 million to launch the company, build the product, and start selling it. So this is the kind of situation where the risk is going to be extremely, extremely high. I mean, the probability of this working is much, much lower. So if you invest in this, you need to get a really, 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 really high potential return to risk your money. So let's say that we've done all of the analysis and we've estimated the discount rate to be 50%. So it's, the probability of us getting paid back is much, much lower. And so we need the upside to be really high. And in this situation, let's say we can buy, some percent of the company for $1 million today, and we think 7 years from now, we're going to make 10 times our money. But we don't know how likely it is, and so we've estimated the risk to be 50%. In this situation, let's look at the NPV. So 50%, and then let's grab the future cash flows, and let's see what it is. So in this situation, we're only evaluating that, this chunk of the company they want to sell us is only worth about $585,000 today. So probably $1 million is way too much money, and we shouldn't be willing to pay that. And let's also look at the IRR. This will again give us, a good estimate of sort of what do we think the returns could be. Let's say 50%, I don't really know. 39%. So we think that the compounding internal rate of return is only 39%, but the actual riskiness per year is much higher than the return. So in this situation, probably this price is not going to work for us. We would have to renegotiate, and it would be a bad investment based on this NPV and IRR model. Okay, that's it. Now you should feel very confident about how to calculate NPV and IRR and use them to analyze investments. If you like this video and want more, check out some of my Microsoft Excel training courses below. Hit the like button. Let me know in the comments. Please, please, please subscribe to my channel and check out some of my other videos. Thank you.